Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for the week ending Friday, August 2nd, 2019. So the sleeping giant has finally woken up, after weeks and weeks and weeks of extended low. In fact, it was more than that, as months. I forget the statistic. It was in the Wall Street Journal lately that this period up until the recent breakdown here, these wedges, was the lowest consecutive period of days where the S&P 500 did not exceed a trading range of 1% in a single day. Up until this point, this was up until then, that was the record. Well, I shouldn't say we didn't break that record, but we did have an extended period of low volatility. And again, yeah, it was all talked about that from those low periods of volatility. Once you get the catalyst, which is almost always a technical breakdown, then that's when volatility expands. So yet another, nice day to the downside, and it's more importantly, it's confirmation of the sell signals. They were a little bit suspect with the Fed, the big move down on the Fed day. Then we had the back test, and as I said in today's earlier video, I did a midday market update earlier today and stated that pretty much, my views are certainly that Trump's tweet accelerated the selling, but again, the technicals had it. We already had reversed there and then had those 1 minute breakdowns that I highlighted yesterday, and then the tweet came, and it only helps speed things up to where we're going, based on what the charts are postured, how the charts are indicating. And now today, of course, that's just additional confirmation. There's no tweets or anything today. Today was just pure raw market action in response to the recent breakdown. So nothing more to say other than it's confirmation of the recent sell signals that we had, the breakdown, impulsive, our back test with impulsive followed by impulsive selling. We almost kissed that 185.70. Remember, it's a rough support, so boom, boom, boom. First target hit, and on QQQ and on SPY we had there's the breakdown. A member of the site brought this to my attention today. They had a trend line they were tracking here off the lows, so I've added that. It works well, and I said this at the time. I added that trend line. We were right there when I added it in today's earlier video, and I said it needs to have a reaction to validate it, because in my book, any 2 points can be connected at random. The 2 points I'm referring to, of course, are the lows from December 24th, and then this reaction low right there, and we did have a reaction off it, so that helped to validate that level. So there's a lot a few things to point out today. Number one, the breakdown, back test, and now an additional move down, a move below 294. The bulls certainly had a chance to, bounce and break that intraday, and I mentioned this earlier, and recover 294, at least close back on or above it. And if so, that would have been acceptable. If you really back out all the bearish stuff that went on, let's just say in a vacuum, as I always talk about, back tests of a well-watched level, 294 again was not just a random level. It was, where do I have it? Right here. I think I have a board with that. You know what? Let's just use this board. Let me take away this line because that's where I had us going down. Okay, so 294 to reiterate, or for those that are just coming in, catching my analysis now for the first time in a while, we had two major reaction highs in the S&P 500 there, a third failure right there after a failed breakout attempt, and finally we broke out. So this is the breakout range above the pretty much double top, almost triple top high. And now we've failed it. And what I was saying before, it's quite usual and common to see a back test of a watched breakout level not reverse exactly on that level to the button. That would be almost too easy, but to come down below and then go. Now we could still do that Monday. Anything can happen. That's why today's Friday. They parked it right below there to keep everybody guessing. But if you want to take things on face value, now if this is undone next week, we rally up. And as I believe I said in yesterday's video, and or today's video, one of the two or both, the only thing right now that would change my intermediate to near-term bearish outlook, in other words, I see more downside in the coming days to weeks, counter trend rallies aside, but the only thing that would change that, we'd have to undo all these candles, especially the last few days here, these three red candles after the breakdown. That would certainly call the bearish scenario into question. But as of now, again, if you want to take it on things for what they are on face value, that's it. breakdown, back test, impulsive rejection, then a break of support. And that's, like I said, the nature of a rally. I like to assess those, a rally or a correction. I like to assess them as they come. And if we go smashing through key support levels with very little, if any, reaction, then that's it tells you the nature. Now we did have a reaction right there. You can see off 294 that yesterday's candle, but again we went down through it today. So keep it simple until and unless we recover that. Any kickback rallies at this point should be used as or considered shorting ops. We've gone from a buy the dips to sell the rips market. IWM, I can't recall if I covered it in last night's market recap, but what's going on IWM is also a failed breakout so far. Just like on the S&P 500, that was the point I was trying to make. That drop below 294 gives us what we call a bull trap, because the breakout to new highs failed. And it wasn't just an all-time high breakout above a previous reaction high. Again, it was a breakout of at least 3 failed attempts to get over that level. We come back through it, so the breakout above at this point in time, and until unless it's recovered again, it has to be viewed as what we call a bear trap. A bull trap. Bulls go long, buying the breakout to new highs, and then once that breakout fails, they're trapped in there and want out in a bad way usually. All right, so there's the downtrend line on IWM. I wanted to point out we had this minor uptrend line form this triangle pattern, and we broke out there the other day. Fed induced, had a little pop again right into that 159.41 resistance, a very important, well-defined resistance level, and failed. So more importantly, or similar to SPY, if you will, this whole recent Fed-induced breakout around there above the downtrend line right there is certainly a failed breakout. And that is the nature of a failed breakout or bull trap, is that once it's become clear that the breakout has failed, you usually see the impulsive selling, and it's a combination of two things. It's the longs that took the breakout and now realize that they were wrong, that the breakout failed. And it's also the shorts that come in, like sharks that smell blood in the water. They see a failed breakout, so they pile in as well. Work to be done. We hit some support levels today. Let's go and zero down on how, give you, like I did yesterday, some trading tips, how to trade today, profitably, how to make sure if you weren't short, you got in short. If you wanted to actively trade, there was an opportunity there as well to cover some shorts and go long at the lows. So let's take a look at that. Okay, we're going to start out on, this is the homepage of rightside-of-the-chart.com, and here's the analysis that was posted as of this morning on the market. The first post was this morning about 10:44 a.m. SPY and QQQ coming up on support. So what I did is the first charts above here, I pointed out that this was posted yesterday morning. Let's see what time that was, down lower left-hand corner, around the same time, a little after the market opened. And I gave these scenarios with my preferred scenario, like usual, in yellow, saying if we break above there. This was all covered in last night's video. And so this would be, these are the levels to watch. In other words, reaction points there, those are key levels. Break under the recent lows would open the door for a move down here to my next target at 290.14 on SPY. And that was again posted this morning. Let's take a look at where it is, or what happened there. That was a 60-minute chart, so I flip over here to a 60-minute time frame, and there it was, just a hair above 290.14. And I'm going to get to it in a minute. That we reversed there for a reason. We hit actually support on ES, and I talk about that very often. That's why I don't just post charts on the index ETFs, or I don't just post charts on the future. I trade both, but when you're trading, I like to look at both SPY and QQQ when I'm trading the large caps, and as well as ES and NQ. And if let's say, for example, like today, they're all falling down to comparable support levels. It's that first of the levels that get hit that may produce a reaction. So I'm going to get to that in just a second. So keep in mind. So that was close enough, a quarter point or so within that 290.14 target. Again, that was SPY. That's the real-time chart as of the close right there. This was earlier today. Posted SPY's coming up on the 290.14ish target, where reversal off the initial tag is likely. Went on to post QQQ. This was posted yesterday morning. That's Thursday morning, showing us coming down here, and you can see the additional support levels there. And then today, there it is. Q took out that 188.37 level. You can see a little reaction around there, and was coming down to that that 185.50-ish level where it looked like a bounce was likely. So then shortly after that, again, those were just the index ETFs. I posted at 11 o'clock that the index futures were approaching support. And on these charts, again, the same ones that I posted yesterday morning, Thursday morning, showing NQ and the key levels to watch on NQ and where we're likely to reverse that downtrend line there. And then this morning, about 11 o'clock, said NQ is coming up on the 76.22 support, where a reaction or reversal is likely there. And I went on also to post the ES charts again from yesterday, showing us going down to 214 support right there. This was today. So at that same point in time, and this is where I'm going with all that, there were 4 60-minute charts I just showed you and put out earlier today: QQQ, SPY, ES, which are the futures for the S&P 500, and NQ. Of all 4, 3 of the 4 were getting very close to key support levels where I expected a reversal, but one had already hit it, and that's ES. And ES hit 214. You can pull a 1-minute chart, and we stayed there almost all day trading on 214. In fact, we almost, we closed just a little bit above that level. So that's where, as an active trader, I said I reversed, covered shorts, reversed along for a bounce. The bounce, it came, wasn't much, but it was certainly, a chance to book some profits right off the lows. Because again, if you're watching trading, even if you don't trade ES, like today, I didn't have any positions in ES coming into the day or afterwards. I was trading NQ and some RTY today. But again, if one hits support and you're looking to cover and reverse around that level, and the others are just shy of it, you might as well cover, because what are you going to try to milk out that extra 0.2 or 0.1% for the other ones to come, when the first of those could reverse? If more ES traders are watching and they step in here, which they did today at 29.14, they're going to lift the other indexes when they start buying. That buying will carry over into the NASDAQ 100, which has many of the same stocks, especially a top weighted component. So that was that. And let's look at, I already covered that one. So this is the updated chart and through the close here. So you can see, and we'll zoom in a little tighter there, so you can see that, this is a SPY, hit that 214 level, almost to the button. And again, if you look at a 1-minute chart, it traded, hit it several times, traded above it, and a decent bounce, definitely a tradable bounce for active traders, a day trade bounce. And then, for me, back into the end of the day here, short, came in that bounce, and I'll go home short over the weekend with a mild short exposure. It is a weekend. I'm nothing big right now. Let's look at NQ real quick for you. NQ, again, there's that 76.22 support, but you held some minor support here, and the fact that ES hit and held support is why the market's held up. And on QQQ, I showed you SPY reversing just shy of there in the midday update video today, or follow-up post. I had the 185.50 target, but then I also added, because there's those support levels I just showed you on NQ. You can see a lot of candles right here from back on, when was that? That was around the 28th. That was also minor support there, about 186. That's more of a support zone. And so again, I'm talking a little reaction here. That's all if you want to trade a quick bounce. But I made this clear too earlier today. When we fell to those levels, what I posted to members is, the takeaway from all this is, look, we could have broken those levels. If we did, we'd get some type of another flush down to the next targets if we broke them and it wasn't just a brief spike below. That is certainly possible, but number one, usually you don't get that waterfall type selling after coming off all-time highs. You get this, and as I pointed out in the video earlier today, usually what comes after the initial leg down is the dip buyers step in, tried to grab a circle tool there, and you get a kickback. It doesn't look like much, but it was a pretty decent snapback rally there. You could see it in the S&P 500 as well. You always get these, after the initial thrust down, a little snapback rally. And more importantly, we also hit this trend line on SPY. So you have some pretty significant support levels. The markets are in the very near term oversold, not in the long term. This is the RSI on the daily chart, not even close to being oversold. Near term, I'm talking about the intraday charts. So again, that was what I had said earlier, that at the very least it's not objective if you haven't shorted yet, or if you were looking to add on, you don't add to shorts when we're over near-term oversold and at support. If anything else, you look for, you wait for a bounce to reshort if you're not a very active trader and you don't want to game the bounces. And now at this point, the next signal comes, or sell signal comes, if and when we break today's lows in ES. And remember, as I showed you, there's a little support just below on NQ, and QQQ, and SPY as well. So these are next sell signals. So if I had to guess, it would just be a wild guess. I'd say we bounce Monday, and then sometime next week break down and continue lower, and that would give us a more powerful sell signal, and then head on down to some of the next targets here. Either way, I always say this to everyone: you need to define your time frame and your trading style, and more importantly, where you think the market's going. If you believe that these are pretty powerful divergences, sell signals, everything else that's been covered lately, and that we are going considerably lower, another 5% or more, then and you're not an active trader, then you might want to just ride out any counter trend bounces and set your stops somewhere above wherever you entered. Or if you want to short and you haven't shorted yet, wait for either a bounce back into resistance or a breakdown below, like I said, a break below today's lows. Could come on a gap on Monday. It could come on a gap down. We could gap up. Again, I don't know. It's a crapshoot what happens over the weekend. But so that's very near-term stuff. When the markets start trading next week, when the futures open Monday morning, even before the markets open, I'll have a good idea. I'll be able to see where the futures are, look at levels, see what's going on, and then we might, I'll have a better gauge of where we're going to go. But as of now, like I said, where we go Monday is a crapshoot, coin toss almost. And but where we go over the next week or two, based on what's happened here, especially over the next several weeks, I would say pretty most likely to the downside, again with the next sell signal to come on the break of this uptrend line here, and solidly below today's lows. Okay, guys, we'll wrap the video up with XLK since I didn't mention that, but that to me is a big factor in my analysis because, like I say, tech is the market, it's the largest sector. There's the previous highs from April, major reaction highs in the market. So tech broke out just like the broad market and everything else did here recently, and it's come back in and it's now down below. At this point, again, in a vacuum, if I wasn't paying attention to these divergences and the low volume sell signals and everything that I've covered recently, if you missed those, it was about a week or so ago. I showed you levels where the average volume falls to a certain point on the indexes, and that's where quite often you get the big corrections. If it weren't for all that in a vacuum, I wouldn't, and I didn't see the breakdown here either. I would say, you know what, right now this may just be, and it may prove to be just a back test of the breakout. Sometimes you come a little below, you get a momentum fueled overshoot. Look, we closed at 79.05. That previous that breakout point was around 79.52, and it's not even as well defined as the one in the S&P 500. I can say there's also resistance up here at about 80.29. So looking at tech, and I zoom in, it's these candles right here, quite a few, and the bottom of the body of that candle right there. So I'd say about 80.30 to keep the near-term bearish outlook pretty healthy and intact. Ideally, I want to see XLK remain on a closing basis at least. I don't care intraday if it pops up above and closes. I want to see it close on or below, remain below that 80.30ish level. And again, that's just one sector, so that will go into my analysis. That's not a be-all, end-all, meaning green light, go long above this level, red light, short. No, it's not that simple, but it is definitely a factor into my analysis. And again, if we just continue lower next week, it's only going to seal the deal, solidify, if you will, the bearish developments lately, the breakdown back test, and then the follow-through selling today, confirmed divergence, everything I've talked about in recent weeks, bearish PPO crossover on the indexes, XLK, and everything else. So that's it. And soon, if next week, early next week, we continue to firm up this bearish case, if this all wasn't just a whipsaw signal and we jump back up next week, if that's the case, meaning the charts remain bearish, I'll start again zooming out, focusing on the longer term, the weekly charts, to try to paint the bigger picture, just how far this thing may go, just how long a swing trader might want to stay short. again. So like I said, a little bit of work to be done because we're, for all intents and purposes, we're a little below, but we're essentially still back testing these recent breakouts on the market, S&P 500, NASDAQ, tech, and all that. So the further we go only increases the odds that that breakdown today below those highs will stick. All right, this has been Randy Finney with Right Side of the Chart. Have a great weekend.